This is TreppWire Week in Review for week ending September 23rd, 2022. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Lonnie Henry, Head of CRE and Advisory Services. This week, Treasury yields are surging after the Fed announced a 75 basis point increase rate hike and signaled more to come. A flurry of data on housing. Housing starts unexpectedly rose in August, led by multifamily, but existing home sales fell for the seventh straight month, and permits plunged 10%, signaling a drop in future projects. And builder confidence is at the lowest in 8 years. Manus, markets reacted this week, but the interest rate increase was no big surprise.
Yes, I think the Fed's move surprised nobody. I think that there was a handful of analysts who thought they might go 100 basis points up. There were a handful of analysts that thought maybe 50 basis points would do it, but the odds on favorite was 75 basis points, and the Fed delivered. And normally when that happens, you don't see a whole lot of volatility. But in this case, I think analysts, money managers, market watchers were shocked by both the dot plot and the rhetoric coming out of the Fed after the meeting. For those that don't know what that is, the dot plot is also known as the SEP, and I forget what SEP stands for, but it is basically a polling of the Fed members, which talks about where they think things like GDP will be, where unemployment will go, and where terminal interest rates will end. And there's really no way to sugarcoat this latest dot plot. The board lowered its GDP forecast going forward. It raised its terminal unemployment rate considerably, where where the unemployment rate will get to as a result of the rate hikes. Now they're expecting 4.4%, which would be an increase of about 0.9% from where we were at the trough. And then lastly, the terminal interest rate is now on average 4.6%, which is up considerably from where it was a month or two ago. All of that rattled the markets. We saw a big sell-off yesterday and another sell-off today. After 4 p.m. on Thursday, I'm looking at the futures right now. The NASDAQ is down another 1.5%. Going back to that interest rate dot plot, you had six board members who put in their opinions on that, thinking that the terminal Fed funds interest rate would peak at 4.9%, which would be considerably higher than where we are today. All of that had the impact of slamming the stock market and driving interest rates higher. And we'll go through exactly how much those things have moved.
Yeah, man. So just to give some context to what Powell said, in addition to the rate increase, he was quoted as saying, we'll need a period of growth below trend and some softening in the labor market. Labor market continues to be out of balance with demand for workers substantially exceeding the supply of available workers. And then he gave some statistics basically saying vacancies are still almost 2-to-1 ratio for unemployed people. So I think, we're going to have to see a cooling down in that market. He's, basically letting everyone know that's the intent. Goldman Sachs economists released some stuff, or basically they're calling for another 75 basis point hike in November, potentially 50 in December, 25 in February, which would get to a peak funds rate of 4.5 or 4.75. So it looks like there's still some ways to go if you believe what they're seeing. And I think Powell's basically said that's the trajectory we're on. Global banks didn't waste any time. They followed the Fed's footsteps with big hikes. And then just more local news in the US, but I think pertinent. Martha talked a little bit about this in the lead-in. Existing home sales fell for the 7th month in a row. Building permits plunged 10% in August. And then builders have seen a significant impact. There was a lot of stories this week on Lennar and KB Homes specifically. I think between the two of them, they actually walked away from about 20,000 vacant residential lots that they had under control. So they actually had beat earnings estimates, but said orders fell amid higher mortgage rates. So, they're seeing 12% and 50% drops respectively in their new orders. And they walked away, as I mentioned, from a lot of vacant lots that they were going to develop into new homes. Mortgage rates continued their climb. Average 30-year mortgage rate, 6.29, highest since 2008. And then Barron's had a story this week that kind of did a side-by-side comparison of just monthly payment costs on a $400,000 mortgage now compared to 2021. And you're looking at about a $600 a month payment using their assumptions, higher now than it would have been in 21. And if you go back just to the first week of August and do the analysis, it's $260 more now compared to the first week of August. So all of these folks that over the last few months have said interest rates weren't going to cool the market, and we're starting to see that play out. I mean, homeowners and new prospective buyers have lost about 35 to 40% of their purchase power based on the increase in single family mortgage interest rates. So definitely seeing a dramatic slowdown there. One thing that I would like to keep an eye on, and I think we'll talk through over the next couple of months, is with this increased interest rate environment on the single family side and people not being able to afford buying a home now, we're seeing increased demand on the rental side. So we've talked about this, multifamilies continue to outperform, but we're starting to see a little feedback in the market where maybe renters have taken all they can take. And even though there's increased demand and property owners could increase rents because of demand, their tenants aren't able to pay the increased rent. So I think that's something that we'll start to see some dominoes falling there, or maybe some of these multifamily properties start having slow pays or no pays at the tenant level. So I know, Martha, you were going to probably comment a little bit on some of the company news. It's been a pretty busy week this week.
It was. I did want to mention that when Manus was talking about the SEP, the Summary of Economic Projections, which sounds trickier than it should be. It includes unemployment. And that was one of the things I think that a lot of people took away from the Fed's comments, which was that we will see unemployment take a hit over the next several months, in addition to earnings. And so you saw FedEx announce their earnings this week. It wasn't surprised that they had to raise their rates in some of their business sectors. And they've talked about having to shave about $2.25 billion in dollars that they're doing through some of the things that they already pre-announced last week, which is closing locations, reducing flights. What I'm thinking about, though, is that is an interesting bellwether, because obviously they ship products for retailers, for manufacturers, for a number of industries. And so if they're looking forward and seeing a poor outlook, that obviously has some effects in industries all across the board.
Yeah, and I think it's of a piece. I think that FedEx is the latest firm to come out and say there's frightening weather on the horizon. We've seen that from bank executives. We saw it from Starwood last week. We've seen it from retailers for 2 or 3 months now. So I think it's coming at the U.S. economy from all sides. And I think you dismiss these warnings only at your peril. When it's coming from this many segments of the market, I think you have to believe it. A couple more thoughts on what both you and Lonnie have said in no particular order. Lonnie talked about the 30-year mortgage being at about 6.30%, give or take. That was probably before today's move, which saw the 10-year Treasury jump another 18 basis points. So the 10-year is now at 370. It is up 210 basis points since the beginning of the year and about 110 basis points since August 1st. The 2-year is now at about 410. It's up 350 basis points, give or take, almost 350 basis points since the beginning of the year, and 120 basis points since August 1. And I'll put that a little bit into perspective in a minute, but the surprising thing for me a little bit is that the stock market sell-off this week wasn't even more pronounced given the move in equities, right? You now have substantial distance between the S&P 500 divvy yield, and you have the prospect of lower earnings going forward versus what you can get on a 2-year duration, 2-year treasury, right? You can get 4.10%, which probably means for single A corporates, you're probably getting 4.5%, 4.75, 5. And at some point there has to be, I would think, a bigger reckoning at these interest rate levels for the stock market.
I would just say the kids on the street now just would say that's cray-cray. You know, the market is in uncharted territory and at the pace at which we've seen these changes. And I agree with you, Manus. The reckoning is coming. I mean, at this point, it's kind of undeniable. It's just a matter of when, not if, in my opinion.
So let me talk about something that we're working on now. We're not ready to release the findings, but I honed in on this move since August 1st for a particular reason, obviously partially because the rates have surged since August 1st, but we started looking at cap rates on multifamily loans being made and property sales over the last 18 months. Our own Jen Spillane put together some data for us on this. And what we saw is, and this is a portion of the marketplace, right? It's in those loans and properties for which there was a sale price revealed and for which we had 2021 NOI data on. So it's not the entirety of the market, but it is informative. And what we saw really from December 2021 until July 2022 was a steady march lower in cap rates on the basis of 2021 NOI divided by price rate, divided by sales price, right? Steady decline month over month, every single month. In August, what we saw was a jump, I think, of about 88 basis points, give or take, 88, 90 basis points. And you have to think that most of that stuff was rate locked before the moves in August. So if we've moved 90 basis points pre-August and the curve has moved out 110 or 120 basis points since then, you probably think that cap rates on multifamily have another 100 basis points to go for the next set of data that we're going to see in September and October. Time will tell, but you would think that those would correlate pretty closely.
Yeah, I don't know necessarily that we'll see a direct impact in terms of the next couple of months, but I agree with you, Manus, that over the next 6 months, we're definitely going to see that type of expansion based on the precedent that you just went through. And I think, for what we have this week to talk through is a high level, but as Manus mentioned, we're working on some other ways to take this data and turn it into, some usable, digestible, maybe geographic and other delineations so that our others can benefit from that. So if that's of interest, please reach out to us via email. We'll try to put some stuff together that'll be of use for our listeners.
We hope to do a lot more with this in the next couple of weeks. So look for some really interesting research from us, and grateful for our team for having put together so much data for us over the last 3 or 4 weeks. I know they've been working hard at this. Before we go into our property segments and some more stuff, I do want to, last week we labeled the podcast Bleak Week, as there was a lot of bleak news between CPI and PPI and falling stock prices. Certainly this week has been no better with the Fed moves and stocks falling and interest rates rising. But I will leave this segment with a glass half full note, and that is, even with the volatility we're seeing, even with surging interest rates, even with uncertainty as to whether people are coming back to work in person in central business districts, we are still seeing economic activity, right? Every day that goes by, we see properties selling across the spectrum, whether it's multifamily, hotel, office, and we'll talk about that a little bit. We do see leases getting signed, and we do see loans being made. And why do I point this out? I point this out because in the two most severe crises that the CRE market had, in 1990 to 1994, and from 2008 to 2010, there was a real closing of the spigot almost entirely. There was no liquidity and there was no activity being made. And the fact that we're seeing markets being made and transactions getting done, albeit at a slower rate, means the spigot is still open. There's no panic in the market yet. And that's important when you're talking about liquidity and making business decisions.
So I know we're about a week away from our delinquency report being finalized, but we've seen a number of stories in the last week that give us some preliminary ideas of what's going to happen.
This is not scientific. It's just me looking at the data very quickly before we came on the air. At this point, there's no signs of disaster in the commercial real estate data that we're seeing. The number of loans being sent to special servicing in September, the volume of those loans was not terribly high. There was not a very material change in the delinquency number. The percentage of loans being reconciled with losses, no big bump there either. So, at this point, and it goes hand in hand with what I said a few minutes ago, there is no sign of the conveyor belt being turned off. Things are still transacting. People are still making their mortgage payments. and the market is at the moment stable.
Yeah, I think you can attribute a lot of that, Manus, to just the sustained rent growth they've been able to see at the property level over the last few years. So even though we're seeing a dramatic shift in interest rates, for most of these properties, they've been able to achieve significantly higher revenue at the property level. And until we start seeing a softening of that, or we start seeing people not pay, or we start seeing some of the sublease space in the office sector really impact overall rates, I think the market's probably going to hold on as long as it can. But it'll be interesting to see, if those things start to slow down, rental rates, and it has to at some point. I mean, you talked a little bit about the two last major crises we've had, and we're 10 years of growth at this point, basically, in terms of NOI and cap rate compression, and the appraised values have been never higher at this point on a per unit basis, or in some total at the property levels. So I know Cushman & Wakefield had a report this week where they were talking about if we go into a recession in 23, they could see up to a 20% decline in property values. So that's a kind of a shocking number at face value. But if you consider what these properties have appreciated over the last 10 years, it's probably a pretty soft reset, relatively speaking. So we talk every week on this podcast where we've had properties that have sold for 2x what they were purchased for 3 years ago. So a 20% correction maybe is warranted. And I'm with you on the delinquency side. There's nothing in the numbers, and we talk about this every month. There's nothing that's just jumped out to say, hey, there's some red flags for us to pay attention to. So it makes you wonder if and when that time comes, is it going to be like an avalanche or a waterfall? Because at this point, there's really no cursory or precursor data that would suggest that we're kind of on the tipping point or anything at this point.
Yeah, I mean, I think the one thing that people are discounting too heavily at this point, and I don't want to get into great detail here, but I do think it's something that the market is a little bit shrugging their shoulders on, is the saber rattling going on in Eastern Europe, right? Certainly there was an uptick in the rhetoric coming out of Russia this week. They have deployed more people, right? Drawing more people into their forces, more belligerent language coming from Putin this week. And I don't think that the market has really reflected what can be more hostilities on the ground or more impactful moves by Russia in terms of curtailing energy flows and other things that could really disrupt the economy in Europe, which in and of itself could call for retaliatory measures. So that's the one leg lower that really kind of scares me, that I don't think we've really possibly seen the other shoe yet.
Yeah, we actually, in our Tuesday morning update this week, some of the European manufacturing was actually shut down due to a lack of available power. So that's probably anecdotal at this point, but I think it's valid what you're saying, Manus. If that actually comes to fruition and energy becomes, a point where they can't even open their warehouses, that has some very large downstream impacts that probably is not being figured into the risk at this point.
So let's start with hotels. We have a couple of stories that I know we just didn't get to last week that we want to cover first.
So two things that came out of Bloomberg recently. The first one came from Patrick Clark and Gillian Tan. The CIM Group, which is the owner of Trump Soho, or the hotel once known as Trump Soho, is exploring a sale of that property. In a second article, Gillian Tan said the Aman Group is looking to sell the Crown building. If they do so, it would probably be one of the most expensive hotel sales in the Big Apple in recent years. The article says that the sale could generate up to $600 million. It's the top 20 floors of a 24-story building. Why did this get our attention? I think probably because, New York, Chicago, Seattle, and Portland are, and maybe San Francisco, are the markets we're most concerned about in the hotel space. The fact that two separate entities were willing to consider dipping their toe into the sales market, I thought was a good sign, an indication that they believe that the biggest discounts for hotels in New York are probably in the rearview mirror. Now, there's a big difference between thinking about bringing a hotel to market and getting bids. They may not be right, and their notion of putting these assets on the market came about 2 weeks ago, before the CPI number and before the Fed move. Those types of things have a tendency to change one's opinion as to the strength of the market. But at the time, we saw this as a bullish sign for the hotel market overall and for New York City alone. Speaking about other good news and a market that we talked about in the past, a Portland hotel loan cured. This is the Hotel Deluxe. It backs a $28 million CMBS loan. The collateral is a 130-key full-service hotel in Portland. Why did this cure? Well, it probably cured because Providence Hotels is being sold to Benchmark Pyramid. Providence is the owner of the Hotel Deluxe. My guess is that they had to cure the loan before the special servicer would permit the asset to be sold, but that loan was cured in September. Good news for CMBS investors, as in 2021, DSCR was still negative and occupancy was only 45%. So this is pulling a rabbit out of a hat. Lastly, we saw a request coming from the owner of the Marriott Grand Cayman. They are looking for a 4-year maturity extension. The loan matured in July 2022. Why did this catch my attention? Because in 2021, occupancy was just 5% for this particular hotel. The fact that the borrower wants a 4-year extension as opposed to just throwing back the keys is another positive sign there. So a couple of nice little hotel nuggets there. We did see several cures this month in the hotel space, and it is a market that continues to outperform in general, and it just defies logic compared to where we thought we might be 18 months ago.
You know, what's interesting on those two stories, man, is the Marriott Grand Cayman in 21 had a negative DSCR and occupancy was just 5%. So for them to, like you said, request the extension and think that they're still a viable entity is great news. It's got to be tough to operate a hotel when you're running at 5% occupancy. I mean, that just doesn't make economic sense. And on the Portland hotel, an interesting nugget on that is it had been delinquent 27 different times over the last few years. And so that was kind of an interesting nugget. And for those wondering, if you're underwriting a deal and you have a negative debt service coverage ratio, or you have a negative NOI even, the best way to turn that positive, I heard, is to divide it by a negative cap rate. So a negative NOI divided by a negative cap rate should get you a positive result. Now, I'm not sure the lender's going to work with you on that, but that's an old trick, from the old school. Negative and a negative should get you a positive.
They lost me in high school when they started talking about imaginary numbers. That's when I kind of checked out and said, it's time to go to shop class.
Somehow I don't believe that's true. All right, let's go to office. We've got a lot of stories to cover there, but a bunch of them are actually positive.
Yeah, we'll run through these quickly. It was these stories that kind of informed my open, which talked about how deals are still getting done. I saw enough of these stories this week that I said, things are still happening and there's still some positive developments. And with that, we'll run through them. In California, in San Jose, TikTok parent ByteDance will be taking 650,000 square feet from Verizon. This is at the Coleman Highline property, Coleman Highline 4. For CMBS investors, this backs a $515 million loan, which is both A note and B note. Verizon was expected to be the sole tenant through their Yahoo affiliate. When Yahoo got sold, the deal was off and the occupancy was never taken over. So even though Verizon had guaranteed the lease to 2031, this was going to be an empty space and kind of have pressure on that entire market when you have that much space available. And in swoops ByteDance to take almost 660,000 square feet to fill that space. So that was a green shoot in San Jose. In Houston, EOG Resources, they are one of Houston's largest oil and gas exploration firms. They have extended their lease for 375,000 square feet at 111 Bagby Street. They've been at that headquarters since 2007. Houston, you may recall, has been a terrible market for a long time in terms of energy firms shrinking, giving back space, high sublet availability, high vacancy levels. A $375,000 renewal is just what the doctor ordered there. On the Verizon story, that was from Globe Street. on the Houston Business Journal. That was from Jeff Jeffrey of the Houston Business Journal.
Yeah, I think Martha and Haley, we should probably try to do some sort of charitable event where maybe Manus and I record ourselves doing a TikTok dance over the next couple of months. We ought to be able to get our listeners to pitch in and raise some money to watch us do some fun TikTok dance. Although my kids might get a little bit upset if they see me on TikTok they would say that's cringe, I think is the word they would use at this point. So interesting story there, because that's a pretty big deal, 650,000 square foot of space. We had a couple of others that I can run through here. New York Business Journal announced that Carlyle, which is a large financial services firm, signed a new lease at RXR's Madison Avenue. I was actually just on a panel a couple of weeks ago with a representative from Carlyle. He is based in their DC office. This lease is for 40,000 square foot, 8th floor, 340 Madison Avenue. RXR is building out the space, will serve as additional space for their headquarters at 1 Vanderbilt. Carlyle had representation by JLL. So give a little shout out to Steve Rotter and Joe Messina. And then RXR was represented by JLL's Paul Glickman, Matthew Strachan, Cynthia Wassenberger, and Dan Turkowitz, along with Andrew Ackerman and Alexandra Budd. So pretty large roster of representation there. KC Business Journal announced a story with Blue Cross Blue Shield of Kansas City. They're moving to 1400 Baltimore Avenue, taking down an entire 18-story building. The move solidifies the company's place in the heart of downtown. They've had a presence there for some time, and ends rampant speculation about who would fill that very large 260,000 square foot space that was vacated by Waddle and Reed Financial Inc. Good story there for Kansas City. Blue Cross Blue Shield has been a namesake there for a while.
Yeah, Waddle and Reed was supposed to take the space, and it's a lot like that Verizon story, where there was a transaction where I think they got sold to Macquarie and never took occupancy. And the question was, who's going to take this space over? So a lot of green out there. And you'll notice this little parlor trick where I got Lonnie to do all the hard pronunciations this week. Longtime listeners will know that I really struggle with any name with more than 3 letters. And so I let Lonnie do the honors this week. I think you did pretty well there, Lonnie. I think you got a solid A- on the pronunciations.
Well, I felt like a D when I'm going through those, and with the Texas twang, I'm not sure it adds any value there. So we usually stop at 3 syllables down here. So if I butchered anyone's name, apologies on that. But we want to try to get those shout outs if we can.
So a couple of other office stories, we'll run through these. These are not quite as good. Call this one crab or maybe even bamboo. Bamboo is kind of the worst version of crabgrass. In Chicago, this comes from the Real Deal's Sam Lounsbury. Tenants there continue to really slash space, even though people are starting to come back to the workforce. In this story, Active Campaign is giving back 100,000 square feet at 1 North Dearborn, which is kind of the parenthetical of the story. The real headline came with some data that they put out from Cushman and Wakefield. They said that there's 6.4 million square feet available in the CBD in Chicago. That is double where they were at the beginning of 2020 and is an all-time high. The previous all-time high was 6 million square feet. And they quoted a broker that said, I bet you're going to see another 5 million square feet come onto the sublease market. Quoting again, raw space isn't going to move unless it's super class A. No one wants to contend with the highest construction costs we've ever seen, even with landlords offering triple-digit tenant improvement allowances. So that's a quote from a broker in Chicago. Lonnie, why don't you tell us what that means? If you're reading this and you're a broker or a property owner in Chicago, this has got to be just a shot to the gut.
Yeah, it's interesting. We actually had a Trepp community call this week. And so we had a pretty esteemed panel of appraisers that, represented Integra, BBG, Valbridge, and Newmark. And the consensus there would echo the sentiment here. John Busey, president of Newmark's Valuation Advisory Group, had said, they're not seeing any activity if the building's not steel and glass. If it's not high-end class A, it's not getting any traction. And the reality is, you have a shortage of labor to come in and actually do the TIs. You have increased costs that are going through the roof. as a building owner, you're trying to amortize that back into the rent to recoup that in a reasonable time period. And in some of these instances, it's just not possible. So I think Anthony Graziano, who's the CEO of Integra, had commented that, a lot of these building owners are grappling with the fact that they may be better off at 80% occupancy, keeping the rents in place, not extending themselves on some of these other incentives to try to lure tenants in, because that net effective rent's not going to be beneficial for them by the time they factor in all those increased costs. So I think we're at a crossroads, and we've talked about this on the pod, where the market's bifurcated. If it's an older, class B, C, D office building that's got functional obsolescence, it's a really tough time for them. And without a clear path to alternative use in some of these instances, I think we're just going to see a slow decay of those. And it's going to start off with just raw space sitting there. And as an owner, you're hoping someone's willing to come in and take it as is, or with nominal increases to the finish out. But I think the transition has already been made to the super high end. We've talked about it, Manus. People are downsizing and moving to newer buildings. People are downsizing and moving to Class A space. They'd rather be in a smaller, more amenitized, more modern Class A property than they would have a larger footprint in an older, obsolete building. So I see more of this coming, and it seems like the brokers are echoing that sentiment as well as the appraisers.
Yeah, and I think that, one of the things that we can't dismiss is the wealth effect. We've talked about that as well, that when your borrowing costs, on the personal level, on the U.S. consumer level, they talk about when stocks are down and housing prices are down, people spend less because they feel like they're less wealthy, right? This is something that Greenspan brought up in the 90s. And I do think it spills over into the CEO and CFO suites. And I do think that when you see your stock price down 20%, you're seeing your borrowing costs go up. I do think that there is this desire to shepherd your pennies for a rainy day. And I think that has something to do with Meta and their layoffs that Martha referenced earlier. And I do think that if you take that one step further, the Metas of the world have been enormous takers of space in these Class A LEED certified buildings. And if they are pulling back, who is the marginal taker of that space, of that additional 300, 400, 500,000 square feet? I don't think it's the banks. I don't think it's the insurance companies. I don't think it's ad firms. And if the tech firms are not there to lead the way, even those could start seeing a leveling off or decline in asking rents over time. We'll see.
Yeah, I actually saw a couple of statements from some Austin brokers this week that said it's been a couple of years since they've had footprints of 60,000 square foot of contiguous space in the office market available. And they've had 2 or 3 of those come online, or at least announced that they're going to be coming online in the next couple of months. So, that's been a very tech heavy marketplace. Apple, Facebook, Indeed, a bunch of tech companies over the last few years have moved in there. And so maybe you're starting to see a little cooling off there. And to your point, it'll be interesting to see. You think in those markets, probably they'll have secondary demand to come in and fill that space. But on some of these older, more mature markets, you might not have that next user to come in and fill it.
2 other crabgrass stories I'll throw out real quickly. Liberty Mutual said it's going to downsize in Portland. Emu and Doug phone your office. You made it a new destination for your days in office. They have about 100,000 square feet in downtown Portland. They're going to move to Lake Oswego, and they're going to take a much smaller amount of square footage. And in Philadelphia, a $360 million loan on 1500 Market Street went to special servicing. That loan is scheduled to mature in November. The interesting thing is that this borrower has 2 more 12-month extensions that could have pushed the maturity out to 2024. However, for most extension options, you have to meet certain debt yield, NOI, performance thresholds to exercise those extensions. In this case, NOI is less than 1.0x, 0.91x in 2021, 0.86x in Q1 2022. Occupancy now down to 69%, so which probably means that they can't qualify for that extension. That loan is now in special servicing.
Yeah, I think that's an interesting point, Manus, and not everyone maybe understands is that just because you have an extension doesn't by definition mean you can exercise it. There are those performance metrics that have to be hit in order for you to be able to exercise those extensions. So a lot of these CRE CLO deals that we've seen in the marketplace as well that have maybe 3 12-month extension options also have performance-based metrics that have to be met. So, just anecdotally, there's about $54 billion worth of expiring CRE CLO debt between now and the end of 2024. So we might see some more stories like this hitting the market.
So this last office story, which is still a crab story, makes me want to ask you, Manus, were you a fan of LA Law? For those of you that don't know, that's probably Haley. It's a TV series that was in the mid 80s to the mid 90s that followed these attorneys in LA and their romances and office shenanigans in politics.
I was a big fan. It was a guilty pleasure for me in the late 90s. It was one of those, prime time, I guess you'd call it, professional soap operas, right? Where they follow all these lawyers. I've only watched about 3 or 4 series my entire life, and that's one of them. That 24, Ted Lasso, and maybe there's been 1 or 2 others. But yeah, that was my big thing. After a long day at work, I go home on Thursday night and watch, the LA Law gang, and that was a nice guilty pleasure at the time.
Well, apparently the building known for being the tower in LA Law is facing fast track foreclosure. So that was a story that we saw in Bloomberg. John Gittleson wrote up the details on that.
That thing was once valued at, I think, $250 million. It's on Flower Street. I think Wells Fargo was a tenant once. It used to be called the City Tower, if I'm not mistaken. If they're defaulting on this loan, and I think the loan you said was 107 million, is that right?
Yeah,
I think that's
106.9.
That would indicate that value has fallen considerably over the years. I don't have a lot of insights into that, but it does make me want to go to, maybe you could find it on, what's that thing that usually have on Channel 3, Meet TV or something, where they have all the reruns of F Troop and Hazel and
all your favorites.
Car 54, Where Are You? Those types of things.
I can add a little color there for you, Manus. This one here, the $107 million loan is actually a mezz piece. So there's a senior lien on that that's about 260 million. So this property is levered up to about, call it 367 or so million, and was purchased in 2016 for 336 million. So probably in trouble. It looks like total debt on the building's about $400 a square foot. So it'll be interesting to see how this plays out. And for those that aren't wondering, or those that are wondering, I was born in the early 80s, so don't really know anything about LA Law. Is that the one that has Ally McBeal, or had Ally McBeal, or is that a different thing?
No. Oh, Lonnie. I
like that show too. That was a little quirky. It
was very quirky.
I didn't mind that one either, although I wasn't a regular watcher. I do remember the music being very good in that. I will throw out one Brokers Start Your Engines thing. I may have to follow this up with more detail next week, but Progressive is looking to sell substantial amounts of space in the Cleveland area, and they are looking for new headquarters. And this could come in one of 2 ways. This could be a build to suit office. They are looking for predominantly office space, but also some other space as well that goes beyond office. I think some warehouse as well. But there's not a lot of space in Cleveland. So if you're in that market and you do have space, that's a development to keep your eye on. So Brokers Start Your Engines.
Yeah, we could actually probably get some insight from our friend Alec P with NAI Global there. He's kind of on top of that market. So if you're listening, Alec P, maybe share some insider baseball with us.
All right, let's shift to retail. Some good news that came out of retail, and Retail Dive reported that the company's first investor day in 4 years, Ralph Lauren, had announced that they're going to open around 250 stores in the next 3 years. They haven't disclosed those locations, but it is definitely positive news in a sector where we've been hearing things about cost cutting and cutting staff.
Yeah, you don't see a lot of that these days, where the companies, other than, periodically you'll see, a Dollar General or one of the low end guys saying that they're planning to open another 250 or 500 stores. Right, you don't see this big number of people expanding. I'm more of a Wrangler guy. Lonnie, maybe you should weigh in on the Ralph Lauren. What do they sell in the Ralph Lauren store?
Yeah, that's a little bit above my taste. I think you and I are a little more aligned in the Kohl's section there, Manus. So Ralph Lauren, if I've gotten any Ralph Lauren, it's because I found it at TJ Maxx or Marshall's on sale, and it probably was a mismatch or like something wrong with it. This comes on, this is kind of contradictory. On the lead in, Martha talked a little bit about some of the retail news. Gap was one that said they're about to cut 500 corporate positions. So, you kind of have the tale of two retailers there, where Gap's cutting corporate positions, and that probably will lead to some store closures and other things. Kanye West terminated his deal with Gap, and then you're seeing Ralph Lauren come in with this news of adding 250 stores. So
I think it's Ye now.
yeah,
I'm not sure I'm pronouncing it right, but formerly known as Kanye.
Yeah, so I think we did like some podcast nicknames a few months ago. Maybe we should come back and say, what would our formerly known, new nickname be?
And we did have some retail news.
Yeah, a couple of these, we'll run through them real quickly. First one from Kelly Boucher of the Minneapolis Business Journal. The Har Mar Mall in Roseville has sold for $50.25 million. Fidelis, which is based in Texas, acquired the mall. Why did this catch my attention? Well, the mall, it was built in the 1960s, so by definition, it is kind of dated. It's an older mall. Acting to its benefit, it is grocery anchored. It has Cub Foods, but it does have Barnes and Noble, which we know has not always been a lure over the last 10 years, and it does have a Burlington. So anytime you get above that $50 million for a retail sale, mall sale, we like that. Another greenish shoot, the Chicago Ridge Mall, which backs a $79 million loan, was extended. This particular mall had a Carson Pirie as its top tenant. Carson Pirie was a Bon-Ton brand. When Bon-Ton went bankrupt and liquidated, that mall lost that store. It represented 27% of the collateral space. So this was kind of had the potential for a dead loan walking. In addition, the collateral was once valued at $130 million. It was recently lowered, that value, to $66 million. So the fact that this mall loan was extended for 1 year and it has $14 million of negative equity is a positive sign for the market. It shows that the owner of this property is going to try to fight for this thing. And whenever they do, it's a sign of confidence that things could be turned around. So let's hope that the owners of the Chicago Ridge Mall can pull that off.
Tie in there to the first story you talked about, Manus, the folks at Fidelis, I actually know them. The founder of that company is a Texas Tech alum and has been very gracious to our real estate organization and let us take students down to their office and walk us through their philosophy on retail investment. So they've actually developed a trademark retail standard. So they've created this concept called VAPS, VAPS, which stands for visibility, access, parking, and signage. And they feel like if they can find properties that meet certain criteria within those 4 tenants, they're going to have really good success. And so they've really kind of carved a niche for themselves with grocery anchored retail. And so it's good to see this may be some sort of reposition or value add play, or maybe there's more to the story there. But the pricing is very positive. So shout out to the folks at Fidelis, and thank you for accommodating a lowly Texas Tech adjunct professor and some students when we tried to make a field trip down there and learn a little bit about the marketplace.
I saw Texas Tech was closing their bookstore, or the place where they sell all the sweatshirts and T-shirts and rah-rah gear. What's up with that, Lonnie?
I actually I didn't see that. So was that published somewhere? Or did
Lonnie was hanging out at the Ralph Lauren store? He was too busy to. I don't know. It was in the news this week. Lonnie, do your part, man. Go there and buy a hoodie and
buy a shirt.
Some of those old striped overalls that the kids wear to the football games.
And when we do our TikTok dance, I'll wear those striped overalls.
There we go.
The Trepp LifeComps Total Return Index report was released this week, and the index is a benchmark for the private commercial mortgage market based on data collected from participating insurance companies. It was interesting what the data showed.
Yeah, so for those that don't know, this is one of the consortiums that we manage, and it's called the Trepp LifeComps Total Return Index. And so we go through a calculation and calculate total return for this benchmark of commercial loans. And so without giving away all the details, the headline here is that the 2022 year-to-date return is the lowest on record for the index going back to the fourth quarter of 1996. So there's definitely been a slowdown in the marketplace in terms of total return. If you'd like to get a copy of the report, please email us at podcast@trepp.com, and we'll be more than happy to send you the full report that details the analysis.
Before we, scare the daylights out of everybody about that negative return, we should point out that we've seen extraordinarily high negative returns for fixed income in general, right? For bond funds with 10-year duration, funds that invest in 10-year paper, the rise in interest rates have absolutely crushed those returns. And so a lot of this negative return is not property specific performance as much as it is being caught up in the downdraft of a really, really severe uptick in interest rates. So we want to put that in perspective, that people, they don't race to the phone and call their brokers and say, sell, 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 right? No need to go all, what was that movie with Eddie Murphy? Trading Places. We don't have to go all Eddie Murphy. Get back in there, sell, 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 right? No need for that.
Stay calm. And an opportunity for our listeners, if you know a college sophomore, junior that's interested in real estate or commercial real estate finance, our academic team is looking for brand ambassadors. It's a great opportunity to get involved, doing some practical work in this sector, and do it while you're going to school where you are, so you don't have to travel. If you're interested in that, give us a shout. We'll be happy to give you the details and put you forward to the person who's looking for those folks. And shout outs. Emily M says she loves the podcast and the fact that it's presented in digestible ways for beginners and experts in the field. And she did have a question surrounding sustainability that I think we can send her some more information when we've had a chance to look at some of the information around that. Kurt A enjoyed last week's Bleak Week episode. Sounds ironic, I know, but wanted to give us a shout out and is interested in upcoming loan sales episode, which we talked about last week. Arpit G cited our FedEx exposure data where we talked about that. Old Reliable, AKA Markets Junkie, TreppWire produces the only podcast that matters, which again, another very kind thing to say. Shlomo C on Twitter recommended his followers to follow us. And on Apple Podcasts, a shout out from Michael H says it's a great podcast and easy listening with beneficial information. And I gotta say, of all the categories that we probably could be in, easy listening was not the one that comes to my mind.
Is that elevator podcast? Like, do they do that yet? Like, I haven't been in an elevator in a while, but they used to have elevator music. Are they going to someday have elevator podcasts? Like, do they have?
That's what I was. That's where my head was at. Easy listening was definitely a radio segment that was pegged of a certain type.
I would say Lonnie's, that likes that deep Texas drawl. I would say that's like borderline sultry. I think that's the kind of thing that would do very well on an elevator.
Maybe, hey, give me a tryout. I'll see what I can do with that. But I think we got to give Markets Junkie some Trepp swag for his Twitter shout out. So
definitely,
if you're listening, Market Junkie, we got something for you. Hit us up. For our listeners out there today, I want to give a quick shout out to Martha, who's done this podcast with only one side of her eyeglasses attached. The other side it's missing. It's missing, and every time she turns her head, I'm like, is she really wearing glasses without one of the arms? And the answer is yes. So,
well, I thought it was like you, Lonnie, with the smoking jacket. I thought she had like opera glasses on that, she just kind of snaps open and puts on for the podcast. I think you guys are, after this, she goes to get some caviar and maybe a visit to Ralph Lauren. I don't know.
Wow. With that, we'll close. Thanks to our producer, Haley Keene. Join us next week as we look at what's happened during the week and how it may be impacting you. If you have a question or comment, send your email and question to podcast@trepp.com and subscribe with your favorite provider. Thank you for listening and stay well.
All right.